morning, happy Sunday, and Happy New Year from Frosty, Chicago. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, January the 5th, 2024. Our podcast theme today is, how did you do in 2024? This is the time of the year that both professional and individual investors alike kind of take an inventory of how they've done over the past 12 months. It's kind of a natural break to look backwards and see how successful you've been. This is also a time when investors start to consider acquiring different research or better research or a new investment advisor. In today's podcast, we're going to take a look at the 2024 performance of our own models and introduce two brand new models that we have created over the past quarter as a new part of our research service. And we're also going to look at the 2024 performance of our four model portfolios, which are available via our asset management service. We're also going to take a look at how the market is setting up for a directional move this month, according to our latest weekly wrap-up report, which is a weekend report that basically looks over the previous week and tries to give our research subscribers an idea of what to expect in the upcoming weeks. It's one of many reports that we offer via our premium research service. So let's begin. Let's begin by seeing how we did last year. So we are at asburyresearch.com. This is all the free part of the website, so you can do this yourself. But we're going to go to research, and we're going to go to our correction protection model, or CPM as we call it, and see how we fared. So let's go down to our chart first. This is a daily chart that goes back to the fourth quarter of 2017. So we back tested this about 7 years back, which for us 5 to 7 years is our sweet spot in terms of how far we want to go back in a back test where we're staying current and we're not going back so far that the conditions have changed, economic conditions have changed to where we believe if you go back too far, the data becomes irrelevant. I want to stay relatively current, and we find that 5 to 7 years is a good spot for us. So what this shows is that our CPM model, which is a risk-on or risk-off model, the way we back-tested it is if CPM is risk-on, we're buying SPY. If CPM is risk-off, we're going to cash. What we do for managed accounts is rather than go to cash, we go to a short-term bond surrogate. We're currently using BIL as the ticker. So basically what we have here is a dynamic stock and bond portfolio. Instead of set it and forget it, where we determine that you're a 60-40 stock and bond person and we hold that into the future, we let the market tell us whether we should be in stocks or if we should be in bonds. So what this is showing is that during this period, 7-year period, a little more than 7 years, CPM is stuck like glue to the S&P 500. CPM, trading it via SPY, is green, and SPX is the blue line. You can see how very close those two are together. Why is this significant? Why not just buy the S&P? Because we have much better risk numbers. Here is CPM versus SPY. You can see the annualized total return from 2017 to 2024, nearly identical. But the difference is the maximum drawdown in the S&P was 33.9% during this period, and for the CPM it was only 20.2%. You can see the Sharpe ratio is better, the Sortino ratio is better. You can find definitions for all of these if you go to investopedia.com. Our beta is lower. Standard deviation is almost 5% less, which means your account is less jumpy. It means your P&L is less jumpy. So basically what this has been doing over time is giving us the S&P, it's been giving us the S&P 500 with about 40% less risk. This past year, you can see we trailed the S&P by 3.1%, but we did it with about 35% lower drawdown. So again, this model was built for older, wealthier, or just more risk-averse investors to be able to get the market with less risk. So let's move on to our CEF model. Going back up to research, we're going to go to our CEF model, see how our CEF model did for the year. So here's the year of 2024. Our CEF model trailed the S&P by 1.9%. CEF is a sector rotation model that over time, this is the most important part for us. So here's our model performance from Q3 of 2018 through the end of 2024, and it shows that our annualized total return during that time was 8.0%. So we're not outperforming every year, but we're outperforming annualized by 8%. Our maximum drawdown was 29.4% as compared to 33.9% for the S&P 500. This was during the COVID period. Sharpe ratio was 104 versus 63 for the S&P. Sortino ratio was 204. Our beta is a little lower than the S&P at 0.87, and our standard deviation is right on the S&P 500. The S&P was 17.5 and 17.3 for CEF. Here is what the chart looks like. CEF during that period is the green line, and all we're doing with the CEF model is we are rotating into what CEF finds to be the top 3 ranked sectors, and this is according to our own quantitative methodology, which measures the velocity of money moving around the sector space. Those 11 sector spiders basically represent the S&P 500, and you can see over time quite a bit more outperformance by CEF. And so all we're doing with CEF again is this is updated weekly. The model is updated every week on Saturday, which is usually available by midday on Saturday, and we're always investing only in the top 3 sectors as indicated by the CEF model. Now we have a couple of new models that were introduced this year. So let's go back to research and take a look at our CPM Ultra model. This is a variation of CPM. The difference is what we're doing here is we are upping our allocation to 50% of that allocation is going into SPY, just like CPM, but 50% is going into SSO. SSO is a 2 times leveraged ETF of the S&P 500. Gives us a little bit more horsepower. So we can see this is what the chart looks like for CPM Ultra going back to the same date, October of 2017, so a little bit more than 7 years. You can see CPM was giving you the S&P 500. These 2 lines were together through the whole time, where you could see this time, using a little bit of leverage, or 50% leverage actually, getting a lot more alpha, getting a lot more horsepower. It's outperformed by quite a bit here. So during this period, annualized, it's outperformed the S&P by 4.1% per year. Again, this is annualized. Standard deviation is a little higher for those that want to take a little bit more risk. 16.9 for the S&P during this period, and 18.8 for CPM Ultra. Our beta is just a little less than the S&P. They're effectively the same. It's 0.94 for CPM Ultra and 1% for the S&P. And our maximum drawdown is still a little bit less. This is the one that's the most important to me, is the max drawdown. S&P, again, 33.9% during the COVID period, only 31% for CPM Ultra. The next one that we're going to look at is our CEF Ultra. So we have taken CEF and we've added a little bit more horsepower to CEF as well. These are all available through the Premium Research product. So here is the CEF model, and all we've changed here is when we see exceptional asset flows going into any sector, that sector is going to instead of trading one of the sector spiders, we are moving that particular sector to a 2 times leveraged sector. And you can see, we don't have it here, but there are 2 times leveraged sectors for all of the 11 sector spiders. So all we're doing is we're adding a little new wrinkle there, where if we see exceptional asset flow into any one of our top 3 sectors, we are using a 2 times leverage for that sector. And you can see what it's done for the performance. Here's our CEF Ultra right here. The wrong page. So here we go. So here's our CEF Ultra. And here's what I was looking for right here. These are the 2 times leveraged equivalents, ProShares products, but these are the 2 times leveraged for all of the sector spiders. This explains how, if you want a little bit more detail, again, just go to asburyresearch.com and go to CEF Ultra, and you'll get a little bit more detailed explanation of how this works. But basically, this is the difference now. From 2018 to 2024, the same dates that we have backtested CEF, the Ultra annualized total return is 15.5% annualized better than the S&P 500. It's 27.3 for CEF Ultra versus 11.8. Now, the maximum drawdown is still a little bit less than the S&P. It's 32.2% here versus 33.9 for the S&P. Standard deviation is quite a bit higher. It's 26% versus only 17.9. That basically means that your P&L is going to be a little jumpier. The beta, it goes up to 120 versus 1, which is the standard for the S&P 500. But this is just another way to use sector rotation with a little bit of leverage at opportune times to basically double what the annualized total return has been for the backtest by using this Ultra, CEF Ultra, which is kind of a high horsepower version of CEF. The next thing we're going to look at is we're going to go to our asset management page. We have 4 different models, 4 different portfolio models here, or model portfolios. We have Asbury Aggressive. You could download the prospectus here, which we're going to do. Let's make this a little bit bigger. And what this is a combination of our CEF model, our CEF, and our CPM model with a little bit of leverage. Here is cumulative 5-year returns. Asbury Aggressive model portfolio is here in green. The S&P is in blue. And you could look at all of this whenever you like. This is all in the free part of our website. Here's a year to date. In 1 year, which are now the same, because this was updated through the end of the year. This is the 3 years, the portfolio versus the S&P, and here's the 5-year. And here is the 3-year cumulative returns, and here's the 1 year. You can see that the 1 year were pretty much equal to the S&P 500. There wasn't a lot of sector rotation relative outperformance this year. The sector rotation was very fast. It wasn't very sticky. So we were basically a market perform this year. And here's all of your risk metrics. The maximum drawdown during this period, 21.7 for the model portfolio versus 33.9. So still a pretty low maximum drawdown. Our Sharpe ratio is 106. Our Sortino ratio is 2.26. And our standard deviation is effectively the same. So let's look at our next one here. We're going to go back. Again, we're going to asset management. And we're moving down to the Asbury balanced model portfolio. And this is basically a 50-50 blend of our CEF and our CPM model. And we'll just kind of breeze through it here quickly. So you can see the Asbury balanced in green up at the top here, and the S&P 500 is down here in blue. Here's our periodic returns. We underperformed like by 2% this year, so you can see that here. 3 years we outperformed. 5 years looking backwards we outperformed. That's the 3-year return. Green is the Asbury balanced model portfolio. Blue is the S&P 500. Here's quarterly returns over 3 years. You can see this. I'm not going to spend too much time here. And you can see we underperformed by a couple of percent here over the past year. And here's our numbers. Standard deviation is less than the S&P at 14.3. Our beta less than the S&P at 0.72. Our Sharpe ratio is 1.11. Quite a bit better than the S&P, obviously. Sortino, 2.38. And our maximum drawdown here, only 18.6 during the 5-year period compared to 33.9 for the S&P. And we have two more that are more conservative. We'll take a quick look at those now. And again, these are all available via our asset management service. And we work with individuals, and we also work with money managers as a third-party advisor. Asbury Conservative, modest capital growth, downloading the prospectus here, and we'll go through this quickly. This model, this is the 5-year cumulative return. Asbury Conservative in green here, S&P 500 in blue. You can see year to date we underperformed by a little bit. We outperformed over a 3-year period, outperformed over a 5-year period. Here's our 3-year cumulative. You can see we outperformed here. Periodic returns quarter by quarter over the past 3 years. Again, all of these are available here, so I'm not going to get into a ton of detail. And you can see we underperformed here by 2.5% to 3%, something in that neighborhood. Here's our numbers. Standard deviation all the way down to 13% for this model. It's more conservative. Our beta goes down to 0.65 versus 1 for the S&P. Sharpe ratio is 103. Sortino is 212. Look at the maximum drawdown here, only 15.5 versus 33.9 for the S&P. So you can see as we're getting more conservative, we're getting much lower drawdowns. Our final one we put together because we had a lot of customers call us and say, could you create a model that could keep my maximum drawdown under 10%? So we started playing around with different combinations of our model, and we brought in a short-term interest rate related ETF, and we came up with ultra-conservative model, which is right here. Here's the prospectus. And again, all of these are back-tested results. Back-tested results do not equal future results. Nobody knows what's going to happen going forward. It hasn't happened yet. But we believe that the best and, in many ways, the most conservative way to trade the markets is to backtest them in a way where you're measuring the risk first, and then you're taking what the positive performance is secondary. We want to reduce our risk because we know the markets inherently go up. Over the past 100 years, the stock market has gone up most of the time. So the game for us is to reduce the risk and to let the market do what it normally does, and that's go higher over time. So let's have a quick look at this. And this is our 5-year return. You can see we underperformed the S&P 500 over 5 years. The S&P 500 was 12.7 and we were 10.3. Over 3 years, we actually outperformed just a touch. And over the past year, we underperformed by quite a bit. Here, 23.3 for the S&P, only 12.3 for the model. But remember, this model is to keep the downside to underneath 10%. Here's our 3-year. You can see we're about equal to the S&P on our 3-year returns. And then here, 1 year, you can see we greatly underperformed over the past year, but this is the purpose of this particular model. Here's the maximum drawdown in the S&P, again, 33.9. We only were 9.3% here. So again, 5 years, standard deviation goes down to 7.2 from 18.2 in the S&P. Our beta is 0.36. That's 2/3 less than the S&P 500. We still keep a Sharpe ratio of over 1. And again, our maximum drawdown, which is the purpose of this, is under 10% while still remaining close to the S&P 500 over time. So our last thing that I said that we're going to do is we're going to take a look at current market conditions. So we're going to back out of here. We're going to go to the Research Center, and this is password protected. This is part of the premium research service, but what we're going to do is take a look at the weekly wrap-up. It's one of a number of different reports that we publish for subscribers throughout the month. This one is usually at the end of every week, and we have the S&P 500 current corrective decline remains intact below 6,000 in the S&P 500. So let's just go to the charts. So here's the S&P 500, and our CPM model and our Asbury 6 model, which we're going to look at in just a second, see an update on that, have both been negative over the past couple of weeks, indicating the market's in a corrective phase. So the resistance level that we think that we need to watch the most closely in the upcoming week here is 59.97. Let's just call it 6,000. And what we have here is the 21-day moving average, which is the pink line here. It's the monthly moving average. And it's also, which doesn't show on the chart, it's a 61.8% retracement of this move down from the peak that we made on D6. So underneath 6,000 would actually corroborate what we're seeing with the CPM and the A6, and that's the market is in a corrective phase. The big support level that we're watching this upcoming week is right around 58.30. It's about 1% underneath where the market is now. If we break that, we would actually confirm a bearish chart pattern. It's a head and shoulders pattern, and the implications of that would take us all the way down to 55.59 here, which is a 200-day moving average. So above 6,000, the market's starting to get better. It's starting to heal itself. Underneath 6,000, we're still in a correction. Underneath 58.30, we would expect the correction to accelerate. And this is about another, from 58.30 to 55.59 is about 4.5%. So these are the levels I think we need to watch for next week. Here is our Asbury 6. Our Asbury 6 has been negative as of December the 16th. It is still negative now. 4 or more of the constituents have to be read in order for it to remain negative. What negative means is it means the market's internally weak. 4 or more of these would need to turn to positive, indicate that the market is starting to get healthier, and perhaps we can have another leg higher here. But right now, going into next week, as long as 4 or more of these remain red, we're still in a internally weak market on a tactical basis. The third chart that I want to look at here is the VIX. The VIX is a very sensitive near-term tool for us. You could see when the VIX is underneath its 21-day moving average, as it was here from November 6th to December 16th, we had a nice rally in the S&P 500 that took us right up to the high. Then we jumped up above, the VIX did that is, from the 17th of December, and that was one of many things in our view that indicated the market was getting internally fearful. It was getting internally weak. So look where we are right now. We're sitting right on top of that 21-day moving average, monthly moving average at 1622. Above 1622 next week, that suggests the market is still fearful on a tactical basis, and that would support lower prices in the S&P 500, the index weakening further. If we break down below 1622 and stay there, that will be an indication that the market is taking a sigh of relief for whatever reason there might be, and we could see the market start to re-engage the rally that we saw for most of last year. So there you go. Let's go back to the homepage here at asburyresearch.com. Finally, we have a low-cost entry-level online newsletter called Asbury Research Chart Focus. There's a pay version for that for $25 a month or $250 a year, and there's also a free version. To sign up, for whichever of these versions you like. Just visit asburyresearch.substack.com or look for the Substack link that's going to be below this video. So there you go. That wraps up Asbury Research Following the Money podcast, the first one for this year. Our next Follow the Money is tentatively scheduled for Sunday, Jan the 19th, 2 weeks from today. Happy New Year to everybody. I hope you had a good 2024, and I hope we can help you to have an even better 2025. For questions or more info on any of the research, the models, or the model portfolios that we talked about today, you can contact us via the contact tab right here at asburyresearch.com and let us know what you're interested in, and we will get back to you with further information. And finally, don't forget to like and subscribe. Have a wonderful couple of weeks, and we'll see you again on January the 19th. Thanks for watching.